Hey guys, Ken Boyd with the Accounting Accidentally website, where you can find over 400 blog posts on accounting and finance topics and 350 links to my YouTube videos on accounting. So what I wanted to talk about today is capital budgeting and dealing with present and future value tables. I think a lot of people get lost in the tables. They don't really get the concept. This is a way I've explained how they're used practically. So let's assume Levi's company that makes blue jeans needs a new sewing machine. The cost is $10,000. And the annual increase in cash, because the machines work more efficiently, Levi's is going to get $2,000 a year more in the door than they did before. So those are $2,000 cash inflows each year for 6 years. The annual rate of inflation is 5%. You may also see that stated as the acceptable rate of return. So the present value tables we use are discounting at 5% present value for 6 years. That's where I'm coming up with column B. In column A, year 0 on day 1, we pay out $10,000. It's an outflow. Years 1 through 6, we get cash inflows. And you'll see here, column A, column B, I multiply across, and I get what the present value of both the inflows and the outflows is. And if I add them all up, they add up to a positive number 152. And if it's a positive number, you would make the purchase. Now you'll note this number here, that if we only got the cash flows in for 5 years rather than 6 years, the total would be a negative number and we would not make the purchase of the sewing machine after 5 years. But after 6 years, that extra year of cash inflows makes all the difference, and we would make the purchase. I'm going to scroll down to pick up a term here called payback period. The original investment divided by the annual cash flow. You'll note that these are not adjusted for present value. $10,000 that we put out the door for the sewing machine divided by the annual amount that we get, $2,000, it means that we recover or get paid back our original investment in 5 years. The cash is returned, but in today's dollars, you're not yet profitable at the end of 5 years. So at the end of 5 years, if we use present value, it's actually a negative number. So important point on payback period. A couple other things I wanted to pick up on this tab. Another term is accounting rate of return, which essentially flips the ratio. We take average annual cash inflow, $2,000, divided by the total cash outflow, $10,000, we get a 20% accounting rate of return. But again, this does not adjust for present value. And finally, what if the payments are uneven? What if we pay out $10,000 in the beginning and the payments are uneven? We get fewer payments in the beginning and more payments in the end. Well, remember that all these payments are going to be discounted using the same present value tables above. So the timing of the cash flows makes a difference. Can you as a company in this question manage your business with smaller cash inflows in the early years and hang on until you get the bigger cash inflows in the later years? So uneven payments is a different issue. So that's what I wanted to mention on capital budgeting. Remember that you can go to the conference room. The address is up here, the website address, which is an accounting community where you'll have blogs, videos, chats, events that you can join for free. Thanks for watching, and we'll see you next time.